Let's go.
Let's go. All right. So how often do you get the question, should I be reinvesting my dividend or should I be taking it as cash and then strategically investing that somewhere else? I mean, how often do you get that?
Probably 50-50, just kind of depending on the scenario and the situation for the client. But you definitely, especially as we approach retirement, clients are like, all right, now I'm ready to take the dividend. How should I do that? What does that
question
look like?
I get a lot.
So it kind of is do I take it as it's paid out? Do I set up a consistent stream each month? Do I just wait until I need it? Do we reinvest it until I need it? Does it go cash? What do we do with this dividend that we've talked about for years and now I actually need it? What do we do with it?
So I love, that's what we're going to talk about today, which is this big question. Should I be, before I need my dividend, should I be reinvesting that dividend or should I take it as cash? And if I take it as cash, what do I do with it? I don't get this question very often.
Yeah.
The latter question that you talked about, okay, I'm getting ready to retire. How does this work? I get that question all the time.
Yeah.
So let's just dive in to the case for dividend reinvesting.
Yeah.
This is pretty strong.
Yes.
So where do you want to start here?
I mean, I think it was Albert Einstein who said that compounding interest is the most powerful force in the universe. I would say if that's the most powerful, dividend reinvestment is the second most powerful.
Yes.
Because you're constantly taking cash that's not really, it's yours, but the company's giving it back to you. And then you're just able to buy more shares, which then increases your dividend. And oh, by the way, if that stock is increasing their dividend, now you've got twofold of what's happening.
And there's what's the name of the site where we can show?
It's called Dividend Channel.
Dividend Channel. So if you go to dividendchannel.com, they have this super dividend reinvestment calculator.
Yep. Called the DRIP calculator.
Where you can put in a stock and, Duke Energy, and you can start it from like 1995 or something like that and put in $10,000. And it'll show you both scenarios. What the stock price, value shares, compounded interest will look like today versus taking the cash out and if you didn't do that. So it's a really good comparison of like a growth stock versus a dividend reinvestment stock, a DRIP stock. And without fail, in every single case, it is staggering how much better the reinvestment is. Like it wins 100% of the time. It's not even a question.
Yep. It's wild to see, and in most scenarios, you're like, oh, that looks like a pretty good return over, 30 years. But then you add on the dividend, and not to mention the fact that, oh, by the way, that's real cash that now you're still getting a dividend on.
Yep.
So it's fascinating.
Well, my favorite thing to look at isn't necessarily the value as much as the amount of shares that you have.
Yeah, and a lot of times it almost doubles.
Or
now,
triple,
granted, we're looking at a 30-year span, but
Yeah.
still, it doubles or triples the number of shares that you have.
It's crazy.
Yeah.
So I don't want to spend a whole lot more time on this, but the case for dividend reinvesting is super, super strong in and of itself. You don't have to do anything. It's on easy street.
That's right.
Check
a box.
And let's flip out and let's talk about taking cash. And again, this doesn't come up a lot, but every now and then there'll be a client saying, hey, have you ever thought about X?
Yeah.
Taking this cash and then strategically investing it either in a different stock or waiting for the stock to go down and taking advantage of a dip. And my first typical response is, well, who's going to make that call? When the market's down or that stock's down, who's saying, okay, this is the point. And the hard part is, let's just say you started stockpiling cash from a dividend, and then at some point you're like, all right, it's down. Is it actually down?
Right.
Because where did that first dividend, second quarter, third quarter, where were the stock prices at that point? Who's going to track all of that?
Yep.
And then make sure it's below all of them so you can reinvest in. I mean, that's a nightmare scenario.
It may just be lower than it was a year ago, but you've been stockpiling cash for 3 years because it's been on this trajectory of great growth. Meanwhile, you missed all of that reinvestment
lower value.
that you could have been at lower value. So
the compounded additional shares. So if you wait a quarter or 2 or 3, you don't have those extra shares paying that extra dividend, which is the Albert Einstein compounded interest theory.
Yep.
In addition to this reinvestment theory,
Correct.
which is, hey, we have more of it now. So it's actually paying more of the more.
The snowball is getting bigger, and you forgot about that part.
I don't want to sound like we're beating up the cash, reinvestment. It's just a totally different animal. And if you don't understand the stock volatility, because there are certain stocks, and I can think of one example, Duke Energy. Energy companies trade in a lot of ranges, where I can tell you there are probably a dozen or two clients that I built a strategy while they were still working at Duke. They were mirroring our portfolio, and he's like, "Hey, can we take the dividend? Can we buy and sell?" They weren't doing this with the dividend, but they were doing a strategy that we created to buy and sell the dividend or the Duke stock, and it worked very, very well. We didn't go to the degree of just doing it with the dividend, but you could argue we could have. So I'm not saying this is a strategy that we would never incorporate.
Right.
But I would say as a portfolio manager, there's no technology that I know of that you can, like, on a mass scale, thousands of accounts, be like, hey, this is the strategy I want to implement, and it work out flawlessly. It's not going to. Even with AI,
variables. Yeah,
forget it.
That's right.
It's going to be super difficult. So,
well, and it kind of goes against another one of those kind of, I guess, golden rules of investing. Is it's like it's so much better to have time in the market than it is trying to time the market.
Yes.
In almost every scenario, there's a few exceptions out there where people time it perfectly. And, bravo, that's awesome. But ultimately, it's the time in the market that's going to end up putting you further ahead than trying to sit there and wait. And when do we put this money in? And when do we take it out? And then do we rebuy? And what do we do with this dividend? I think it'd be a mess. People would be calling us a lot, ready to get angry.
So last year, I wrote some more books and that are coming out this year, 2 different books, and they're in the editing process right now. And the first note I got back from my editor on the one book, I have one for advisors and one for investors. And I don't remember which one this is from, but I opened up the book with an example. It's for the investors. And I opened up the book with an example of dividend investing versus growth investing. And I compare the two. And I used 100 years. And I show the difference between dividend reinvesting and growth reinvesting over a 100-year period. The editor's like, this is awesome. It's great, but it's 100 years. He's like, why would you use an example that takes so long?
Right.
Can we have the same impact not being 100 years? Like, can we use 20?
Yeah.
And I guess from a management standpoint, I didn't see it. Like, I couldn't see the forest through the trees type of thing. Because I'm thinking, just like you said, time in the market is so valuable. And yes, the longer you're in it, the better it gets. But you don't need to be in there that long. I can show that same example in a 15 to 20 year.
Right.
It's not as vast. Because the longer you're in it, the bigger that gap gets.
Correct.
So at 100 years, like, the growth portfolio could never keep up. I mean, it's so big.
Well, think about how many years of consistent growth you have to have, and
You're
getting it right every time and of that.
And the dollar cost reinvestment, that we're talking about here is why the growth investment can't keep up, because you have so many more shares, bigger mass that gets you further ahead, that when the stocks dip for a time, you're reinvesting all of this extra cash that's like compounding this spring.
It's a spring
that
boiling.
when things turn around, the stock turns around. It's like, hey, we have 10% more shares now. So boom, you have a 10%, harder spring forward, and it's so much more works for your benefit.
Yep.
And that's why the longer it goes, like, growth can't keep up.
Well, and on those down years, that dividend, that's your net positive.
Mm-hmm.
Like, on that side of the balance sheet, like, that is always positive. It's always income. It's always helping you move forward. So, like, if the stock price appreciated that year, you may not move forward as much as if the stock price went down, just like you were saying. Yep. But you're always moving forward. You're always buying more shares. You're always accumulating as long as you're reinvesting that dividend.
So the moral of the story so far is...
Sorry to beat up the cash takers.
Just let it reinvest. The clients that were taking cash in the past were the same type of clients that just didn't get it. the worst thing you can do is take your dividend and put it into a cash account, reinvest the dividend, in my opinion, whether you're investing on your own or with a professional like us. On the flip side, let's talk about the clients that need cash, that retiree that's like deer in headlights.
Yeah.
How's this going to work? And I want to talk about two scenarios. I want to talk about the scenario of taking 100% of your dividend because you need to live off of all of your dividend cash plus Social Security. I want to talk about the people out there that don't have to take 100%. How do you handle that? Let's hit the big thing right out of the gate, the elephant in the room.
The one who needs it all.
Well, not so much that scenario, but the scenario of, okay, while it's reinvesting, I have all this extra money going back in, which is going to make a bigger pot, but now I'm not going to be able to reinvest anymore. Now I need 100% of my cash. Am I going to grow? Like, is my income going to stay stagnant or is it going to increase? So what, because that's a big question we get.
It's a big question. And hopefully we as asset managers have done our job and we have their portfolio made of companies that not only pay that consistent dividend, but increase their dividend every year as well. So that's essentially getting a pay raise, right? So that we can either keep up or outpace inflation. And that's what we're targeting.
Yes.
So the answer in the short is yes, but that is also why we continue to monitor and keep an eye on these companies so that they are increasing their dividend year over year.
So one of the things that we started doing years ago was created this thing called a snapshot. And a snapshot is just a historical look back snapshot of how things have played out.
With your specific account.
With a Schwab dividend account. So it's a historical, how much you've deposited in any given year, what your withdrawals have been in any given year. So it's a row and columns. It's a kind of financial. And so there's deposits, withdrawals, dividends, and value. So there's four major things that people really care about. So how much money have you given into your account? You're invested. How much have you taken back out? What has your dividend been doing year over year, and what's your value been doing? And the more we've analyzed this data, the more information we've gleaned.
Yep.
And you have the people that we just talked about where you invest and you just let it accumulate and reinvest. And you can see the compounded growth of the return, the total return, and you can see the compounded growth of the dividend.
Right.
So how many pay raises are you getting, as you're reinvesting this? And the numbers they're big.
Yeah.
Okay. Then you have the people on the other side that are spending all of their dividend. And I can tell you, even in those scenarios, it's pretty eye-opening to see, $1 million in account producing $55,000 of income. The client's taking $55,000 of income. The next year, it's at 60 because those companies, to your point, are increasing their dividend. You have some that increase it a ton, some increase it a little bit, but the overall, and I can tell you, on the reinvesting side, before you take cash, we're seeing returns somewhere in the 10 to 15% return of cash growth. So the dividend is increasing double digits just about every single year. And we're looking over tons of different accounts. So we can see historically, after fee, like our clients have been returning huge growth on dividend. Okay. Then on the clients that are they're spending their dividend because they're living their life. They're retired. They need the money. Those people are growing their dividend cash somewhere between the 6 and 8% return. We're not talking about value of the account. We're talking about growth of income. We're talking about dividend income here. So if you're reinvesting, it's double digits plus. If you're not, it's probably that 6 to 8%. Yep. But the biggest issue that we run into where clients are scared is like, where inflation's crazy. Are we going to be able to keep up? 6 to 8% growth, if you're taking 100% of your dividend, 6 to 8% pay raises every single year is pretty substantial. Is it going to be able to keep up with inflation every year? No, because some years inflation's 15%.
Right.
And then there's other years where it's like 2.
Yes.
So I think those are strong numbers that we've seen historically,
right?
Which has been pretty awesome to look at. And for the people out there living 100% of your cash flow and that are in this type of strategy, I wouldn't fret at all. 6 to 8% is pretty amazing.
Yep. I think it's great. It's further validation for us as well, as we're managing our clients' money on their behalf, to be able to see this and sit down with them side by side and say, here's what's really happening with your income, and not hypotheticals. We're not just putting in numbers and
after fee,
hoping and all this stuff. It's like, no. This is really what's going on with your money.
Yeah.
And we can show that, and you're seeing it with your eyes just like we are.
And we have a new system coming out later this year
Yeah.
that I can't wait to get in front of our clients.
Yeah, it'll be great.
That's going to automate that a little bit more.
Yeah.
And last thing is, what about the clients that aren't taking 100%? So they can reinvest some and they have to live on some. How do we handle that?
Yeah, so a lot of times what we'll do is we'll actually break it into 2 accounts. Break it out into 2 accounts. So if you have one IRA, we'll make it 2.
So one IRA at the $1 million.
Yep. So we'd break it. Let's call it.
How do you break it down?
600,000. Whatever they need for their income is.
So let's say somebody needs 20 grand of extra dividend income.
So you're probably looking at, just to keep easy math, 5%. You're probably putting 400,000 into a separate IRA account
that we'd call the income account.
The income. Yep. And then that one's going to pay out all of your dividends into
your bank account.
Into your bank account. And then the remaining 600,000, we could set that to reinvest.
Now, why do we do that? Like, what's the logic between splitting it? Why can't you just take 20,000 out of the one account? Like, why do you have to make it like
you
this?
could, but we kind of alluded to it at the beginning of the show, where this reinvestment is way better than it just sitting in cash. Like, by us having the ability to automate that dividend reinvestment with that separate account, now we're not having to let it sit in cash for a couple days or even months and then reinvest it.
We don't have the technology to say, hey, just pay out this % of the dividend income. So with modern technology, the way it stands right now, in order to reinvest, you can't tell a company in a group. So you have your account that's 30 stocks. You can't say, hey, just give me this % of all 30. It's either paying to cash or it's reinvesting. So there's 1 of 2 ways you can handle this. You can say, hey, pay out these stocks, these 7 stocks that will give you your 20 grand. And reinvest the rest. Now we're cherry picking.
Yeah.
We're in a sense breaking the portfolio logic, which is very dangerous. And that's why we just come to this conclusion. Let's just divide and conquer.
That's right.
We're going to set up this income account over here, and every dollar that goes into there, the dividends are going to go to your bank account. And then everything that stays in this other reinvestment account is just going to get reinvesting. Then you get the best of both worlds.
That's right.
In essence,
hybrid approach.
Wish we could do it in one account, but we can't.
Yeah.
So we split it into 2, make it real simple. We need a pay raise. We just take a little bit more of the 600,000,
That's right.
Put it over there, and then it all pays out. It's pretty simple.
You know, it makes it clear and succinct for them as well.
And the clients that actually have that, then you can actually look at your snapshots, and you can look at the one that's paying out, and you can look at the one that's reinvesting, and you can look at the differences of the dividend growth.
Yeah.
So you can see this account over here is doing that 6 to 8% because we're paying it out. And the only pay raises we get is the dividend companies that are increasing. And what's that average going to be? And then the reinvestment is always going to be more.
That's right.
Because you're adding to the account, which is giving you more income. And you're going to see a much higher rate of return on the dividend growth. The total return is the same. You're spending your return on this side in the form of the dividend. And on this side, it's just going back into the account. This might be slightly higher. It might be a small percentage higher over here because you have the 3/4 of more dividend, 2/4 of more dividend. So it'd be slightly higher on this side, but it's not going to be gigantic. Now, when you start averaging 2 and 3,
well, that
4
snowball
years,
effect starts happening over there.
And I'm just talking about 1 year. The quarterly return is exactly the same. Then it starts creeping after that.
Yeah.
Okay. Any last points?
I think the most important thing, though, is to sit down with whomever your advisor is, or if you do it yourself, make sure that you're doing exactly what's right for your situation. Knowing your income need is still the most important thing. You got to know what you need for the year from an income perspective, and then you can develop which scenario makes the most sense for you, whether that's reinvestment or breaking out your accounts and having some payout.
The last thing I'll say is, we launched the show a long time ago. And along with it, we have this website called planningmadesimple.com. And there's tons of resources on that that go far beyond our show here. That you can find tax strategies, dividend information, income strategy. I mean, there's so many resources on that site. So we don't talk about it hardly ever. That's going to change. We're going to start doing that every show. But if you're looking for more information, have questions, just go to planningmadesimple.com. There's nothing to sell on there. It's just an educational website that we've produced that we continually, I think 6 articles go out a week. So it's
That's great.
It's a lot of information that goes to that site. So check it out. And if you have any questions, you can always contact us through that website. Thanks for listening.